Great. Good afternoon, ladies and gentlemen. Thanks for joining in. This is a very special time for all of us when we are entering into a phase where many things are probably going to keep us on our toes, whether it is about the financial side of the market, whether it is about election side or the political side of the country. We are in the last big 4 months of any financial year, as we all know it, and mid of December, and especially today when we are meeting, it is Monday afternoon. The most active day of any week generally happens to be Monday. I'm sure all of you have taken out time for attending this session. It means a lot for all of us. And at the end of the session, we are sure that you are going to have a lot many takeaways for discussion with your clients on various topics. And the topic today that we have is about, is it right time for commodities? I know this is a topic sounds like more towards commodities, but it is very much related to our investors' portfolio. And in that regard, I would like to invite and introduce Mr. Chintan Haria from ICICI Prudential Asset Management. Welcome, Chintan. Thank you for joining in.
Thanks a lot. Thank you so much.
Yeah. So friends, let me just take a couple of minutes to help all of you and understand who is Mr. Chintan Haria and why we have him here, because he comes with a lot of experience, a lot of responsibilities that he's managing at iPro end. And we look forward to gaining a part of his knowledge that he's going to share with us during next 1 hour. Mr. Chintan Haria is almost 2 decades into financial services side, where iPro Asset Management predominantly has played 2 roles. Started with the fund management side. He has seen the most volatile period of the markets, which was 2008, 9, 10. I'm sure that was amazing period, Chintan. 2005 to 10, he was part of the fund management side, and he took over a larger responsibility of managing the products, and now he heads the investment strategy at iPro Asset Management side. So all the products that we see, they are all going through Mr. Chintan Haria's desk and getting groomed, nurtured, improved, and the offering for all the clients and investors is coming from his side. He's a fellow member of ICI, correct me if I'm wrong, Mr. Chintan. So he's a chartered accountant and a lot of knowledge, a lot of experience. And today the topic we intend to focus on is commodities and what next. So once again, Chintan, so if you wish to share some initial thoughts, then I'll jump to questions that I've prepared on my chit, which I'll be asking you. Yeah, please.
Thank you. So interesting that while we are doing a discussion on commodities, I think generally neither debt nor equity is what people want to hear right now, or rather neither commodities nor debt is what people want to hear right now. They only want to hear about equities, and why not? I mean, I think we've just scaled Mount 70,000 right now in Sensex, which of course is just a number. And we've been saying this in all our interactions earlier as well, that if we are going to move from a $3 trillion economy, now almost a $4 trillion economy, to a 5 trillion, 6 trillion, 7 trillion, these numbers are just but about to be basically, etched in history. And I mean, I was in about 8 to 9 cities in the last 15 days. The kind of buoyancy that I see in India is for real. So what's happening in the stock market generally said as a reflection of what's happening in the economy. And based on what I'm seeing and the numbers that are coming, it's quite reflective of the buoyancy that is there. And we can see that in the GDP numbers, in the GST collections, and in general, the listed companies' results as well. So I think from that perspective, equities continues to do well. And then commodities as a part of the equity basket add on to the investors' portfolio of available avenues.
So while you've touched upon this main topic of having commodities, I mean, let me ask a very basic but very important question. In long-term perspective, do you think really we should be adding different asset classes apart from equities? Because long-term equity and long-term, they go synonymous. And when we bring in other commodities, how relevant it is from the risk standpoint, how relevant it is from the return standpoint. And of course, the liquidity part is something which is left to the fund managers. Yeah, please.
Sure. So when we speak of commodities in general, the biggest commodity which is invested and traded is gold. So I'd like to show to your viewers one chart. I hope I'm able to share it and you're able to see it. It's essentially a comparison of, just confirm to me, Anjan, you can see it, right?
Yes.
So effectively, it's the comparison of the Sensex returns, the bond returns, and the gold returns. It's interesting to see that over the last 15 or 16 years too, that while we all believe equities have delivered good returns, there are years where equity does not deliver good returns. There are years when bonds go through their downturn. And in fact, gold, which is a commodity, ends up being the better of the two. So in fact, if I had asked this as a question, that in the last 6 years, which asset class outperformed the other two the most, as evident from this data, it's essentially gold. So if you look at calendar years 2016 to 2022, in almost 7 years, 5 years, it's been gold which has outperformed. So the point being that commodities do have their cycles which need to be invested upon. And while investors today have by default understood that SIP should be there, funds should be there in their portfolio, which are giving them exposure to equity, wouldn't it be nice that an investment allows you equity, debt, gold, REITs, InvITs, specifically gold today? Because as you would agree, in the last 12 to 13 years, gold prices in the international market being flat has meant that investors have not got enough exposure to gold in terms of a financial investment. So yes, commodities do play a role. While I'm specifically talking of gold, it is across the board commodities, because essentially commodities are something which get consumed and have volatility around it. And as the economies globally grow, and specifically in India, the need for commodities is going to grow. Plus the cost of inflation also means that the commodity prices generally tend to have an uptick around them. So while scenario globally looks weak right now, even a hint of impetus from a global strength point of view would push all the other commodities upwards. And gold, as has been seen in the previous slide, 5 out of 7 years has already done well. And this is probably just the start if I have a comparison. We'll go in detail, but these are the initial thoughts around why commodities should be there, because it provides a good diversification from the existing portfolio which investors may be having.
Thanks for this data point also, apart from your views, Chintan. Now, I'm sure these numbers will remain in mind for many, and they will be able to use these as a reference point in discussions. Thanks for this. Moving to my next question. This is about gold being considered as the only commodity, or should we be looking at beyond gold also as part of the commodity? When we are looking at beyond equity and debt, and then commodities, and you mentioned about REIT part as well, REIT and InvIT. So throw some more light on REIT, InvIT, as well as other commodities apart from gold, which should be part of the portfolio.
So there are different times when different commodities provide you opportunities. While gold is a steady state asset, which is probably always going to be a bulk of your commodity exposure, there are times where aluminum, copper, zinc go through their downturn. We saw that happening between 2012-13 to 2021, where almost for 7 to 8 years, we saw a downtick in commodity prices, and then the uptick, which was quite sharp. And again, we are now seeing some softening happening after 2022. So those being industrial commodities become good add-ons. They are volatile, so I do not expect individual investors to be able to take a call as to when to buy an aluminum, copper, zinc, when to sell, because there are other inputs that demand, supply, etc., which need to be seen. But as professional fund managers, if you get part of it as a offering, as a multi-asset offering, that makes perfect sense. Then there is petroleum, which is natural gas and oil. Very liquid. Oil is the most traded commodity in the world. And they also go through their cycles, right? If you see in the last 6 months or so, we've seen oil, because of a unfortunate war, going up and then coming down, and today being at its lowest in the last 2 years or so. Expectation is that demand slowdown is going to impact the oil demand, and which basically in turn is leading to an oil price going down. Oil prices are also cyclical. They will come down now if there's a hint of uptick in the global economy. Oil prices can go up, natural gas prices also. So there are many tradable commodities in India right now, basically the major ones being aluminum, copper, zinc, natural gas, oil. Of course, the other bullion, which was considered as bullion earlier, but is now more an industrial commodity, is silver. So in the Indian context, while gold and silver were always considered as bullion, gold is still probably bullion, a precious asset, but silver as a commodity, courtesy the exposure that silver has got as an industrial commodity to 5G, solar, and electric vehicles, it's essentially got a certain edge in terms of the industrial demand. In fact, just to highlight to your listeners that last 2 years, silver demand has been more than silver production, which is why silver has basically seen an uptick in the prices. Silver being more volatile than gold, I don't think investors should treat silver as a bullion or a precious asset anymore. Silver should get clubbed with aluminum, copper, zinc as an industrial commodity. But then with the demand going up because of like I said, electric vehicle, 5G technology, solar, 10% of the demand globally for all silver is now these three new age businesses, which keeps silver demand steady. And unlike gold, silver does not get recycled. So that's also a commodity which can be looked at. So there are enough opportunities available. Agri commodities is not something which one should probably think of as, because it's difficult to trade them anyways. But these are the major ones which are tradable and investors can look at as commodity exposures. REITs InvITs is not commodity, but real estate investment trusts and infrastructure investment trusts allowed in India about 7-8 years back. It's a very deep market globally. REITs InvITs are very prominent. It's essentially nothing but, let's say, for example, a real estate investment trust. What does it do? So let's say a company has a certain mall and certain, let's say, commercial complexes from which they are basically getting commercial income in terms of rents and rentals from the mall or commercial complex, which they have let out. They can securitize that in the form of a real estate investment trust. They can create a real estate investment trust in which there is sponsors, etc., and then you get it listed on the exchange. So effectively, as an investor in real estate investment trust, you get the advantage of, let's say, that mall and that commercial complex doing well. And if there is a higher occupancy and that mall and that commercial complex do well and the rates increase, rents increase, the benefit of that is what you get in real estate investment trust. They being passed through vehicles in terms of whatever is the cash flow that they receive, they pay it out as dividends. So generally, REITs and InvITs are a substitute for those who want cash flow, steady cash flow yield. And InvITs is infrastructure investment trust, which could be, let's say, there are power transmission lines, and those power transmission lines are kind of converted into a trust asset, and then you are allowed to participate in that by investing it in the infrastructure investment trust. So these are two examples of real estate investment trust and infrastructure investment trust. These are generally cash generating assets which are securitized and listed so that you can participate in the growing demand for those particular assets in terms of their rental yields or their transmission leading to higher transmission yields. So these are generally used for cash flow purposes by investors, and they are also part of the multi-asset offering that normally a mutual fund would have.
Okay. You mentioned about agri commodities. Agri commodities is like, what's your take as a portfolio manager or product side of it? Are you going to take any exposure or zero exposure in agri because of the uncertainty part or any other regulatory or any other reason that you have?
So agri commodities in general, while regulations may or may not prohibit us from having an exposure or an investor having an exposure, the point being that they are generally volatile, and we've seen instances in the past where if the price of an agri commodity gets impacted, there are certain limitations which are put on the trading of those agri commodities in the Indian markets on the exchanges. So to avoid any stress, it's best that agri commodities are left to the experts. Agri is a very, very specific season type and etc. Not that we can't do it, we are allowed to do it, but it's best to keep your exposures nominal unless you have very deep insight into the agri cycle. It's doable, but just that it's too volatile, and whether the fund can digest that kind of volatility and the overall portfolio, does it add meaningful alpha for you to take that risk, is something which the fund managers normally keep weighing all the time.
Okay. Now coming back to our core commodities part, whether it is gold, silver, or any other. Now, predominantly, general assumption is that portfolios or commodity part of the portfolio is predominantly gold. how far this is true, and in going forward, because you mentioned about silver and the potential being there and the consumption being there. Is silver going to be a major part, or any other commodity in coming times may play a larger role in only the commodities component of the total portfolio? Or your views on that? Yeah.
So clearly, gold continues to remain important allocation. And as we speak, we've been increasing gold allocation in our multi-asset category fund. Just to highlight that particular with a data point, as you can see in front of you, we had 13% in gold in April 22. Then obviously we reduced, the other component became more attractive. Equities became more attractive. Now with our equity exposure in the multi-asset fold coming down, as you can see from the chart, we've increased our gold allocation from 6.4 to 10.9 as on November end. And along with that, there'll be certain silver exposure as well as some other commodities, which may be smaller. But the key being the gold exposure has increased, as can be seen. And that clearly shows gold is the key in terms of diversification from pure equity. And if there is any global, let's say, volatility which can impact the Indian equity markets as well, gold acts as a good hedge. So gold is a large part, and we've been increasing it, as you can see. As far as other commodities are concerned, we are already significantly exposed to silver, but then silver as a commodity has a limited open interest, or exposure levels are limited to that, our fund, multi-asset fund, being large. But yes, we do have gold, which is large. We have silver, which is much smaller than the gold component, but an important allocation. Other commodities are meant to generally trade in and trade out. Currently, we don't have a very strong view on any of the other commodities. But whenever the opportunities do rise, we keep investing in them. And that's how commodities are. You cannot have a very long-term vision on a particular commodity because the prices fluctuate significantly in line with demand and supply. So you have to keep a keen eye as to where is your entry point, what is your profit booking point, so on and so forth. Gold is more a steady allocation, and hence you can be peacefully allocated to it in a long run, especially today when after 13 years between 2011 and 2023, gold is crossing its previous peak, which it hit in 2011 of $1,950 an ounce. It's around $2,040 an ounce right now. So after 13 years, international consolidation, gold is crossing that level which it touched 13 years back. So ideally with that, in terms of the Indian allocation, of course, in terms of the Indian allocation or Indian price of gold, the depreciation of rupee and the imposition of import duty may have added a little in terms of the returns, which in Indian rupee terms, 33. There is some disturbance. If someone can please mute themselves. Thank you. So if you look at from an Indian price perspective, gold has moved from 33,000 to 63,000. That's more due to the fact that rupee has depreciated from somewhere around 50 rupees to 83 rupees, and there's an import duty component which has been put. But otherwise, in international markets, gold has been pretty steady state for last 13 years. 1950, it came down to 1,000, 1,050, 1,100, again back to almost 2,050. And at a time where global uncertainties exist, we do believe gold being an allocation which is larger is helpful to investors, especially at a time where equity markets have done reasonably well in the recent past. Thank you.
I appreciate that. This is pretty insightful. Again, sticking to gold though, but moving a little ahead on this. Generally, it's perceived, theoretically rather, it's not perceived. Theoretically, gold is considered as a natural hedge against inflation. But inflation and the return, somewhere or other, inflation and return, they are slightly difficult to correlate to for a normal individual and all. What they generally discuss is how much it is correlated with the equity or debt returns. So equity is going up and they are coming down. What is the correlation of gold versus other asset classes, be it equity or real estate, if you wish to bring in, or any other? I'm not sure if you would want to speak about real estate, but yes, other asset classes where people look to invest. Yeah.
Sure. So I'll just probably again open that chart just a second. Just a minute. So two charts I wanted to show. One which let me just see full screen. So in the context of gold, just a minute. Hopefully you're able to see this in full screen. Are you able to see the chart? Yeah.
Yeah.
So in the context of gold, I wanted to show one interesting chart. Essentially, if you look at gold versus Fed rate, because one, you are asked a question on, of course, gold versus other asset classes. How does it look? And there are predominantly three asset classes: equity, debt, and gold, which we speak of. If you look at every time the US Federal Reserve peak rates have been reached, after that, gold has actually performed reasonably well, I'd say. The extent to which it does well, of course, depends on the extent to which the interest rates are cut. So if we look at 2000 to 2005, 4, when interest rates were cut, gold did well. 2006 to 2012, interest rates were cut again very sharply. Gold did excellent. Then for many years, gold did not do anything because interest rates were flat. Again, from peak, interest rates got cut, gold did well. And now it is said that we are at the peak of the interest rate cycle. So just wanted to show this slide just to highlight that in the past instance, it has been seen that whenever gold or other Fed interest rates have touched their peak, it's pretty much a good news as far as gold is concerned. And we are rightly there. So gold as an asset class from a comparison with US Fed looks like that. So that's one. Second, in terms of if we compare gold with other asset classes, one is gold beats inflation. So gold compared to debt in the long run generally delivers better returns. Gold compared to equities, it depends which starting cycle you take, which end cycle you take. But in general, equities followed by gold, followed by fixed income is what the risk reward ratio is generally. And if you look at equities, they have already done well. Fixed income is about to just meet inflation. So you're left with gold, where gold becomes an asset class of choice for those who haven't invested in gold for so long, and they would have, by virtue of that, become underinvested. In general, when we compare prices, what we must remember is that there are periods when equity will do exceptionally well. Then there are periods where equity may not do well at that point of time in uncertainty. Gold may do well. And so you can really not time it to perfection. No one knows exactly how to time it to perfection. So in certain manner, if you have all of these in one particular investment, where the allocations are being changed based on a professional understanding of these three investment avenues, which is debt, gold, and equities, it becomes a good choice for investors. Currently, if I look at it, if inflation expectations are that world is going to go through a downturn, the inflation numbers will come down, and people may go towards safe haven investing, then gold becomes a choice. At the same time, if global equity rally may happen because if global outlook improves significantly, China does a stimulus, US does a stimulus, in that time period, maybe equities can do very well in China, and that Chinese equity can do better than gold. So it's essentially always an interplay into which two comparatives are you doing. But to put it very simply, instead of you deciding which one will do well and have 100% of your portfolio in that, having an allocation to all will probably reduce your risk and improve your chances of a long-term wealth creation in your overall portfolio. Thank you.
That's pretty interesting, insightful. I would like to pick your brain on one point, which is again, how do you decide about when to increase exposure to gold or silver or any other commodity in your portfolio and when to decrease? I know that's part and parcel of a fund management job, but just share some insights from it, like, just to understand this part. I'm sure our partners will appreciate this.
Yeah, so if I look at gold, and probably those who heard me in 2016, 17 as well. Since then, I've been saying that maybe a 10% allocation to gold is something which can be looked at. It worked relative to equities in 2018 because in 2018 equity markets fell, gold probably did not fall as much. In 2019-20, equity markets were stable, gold also didn't do much, so it was 50-50 even Steven. 2021 gold in that 4 months between March 2020 and August 2020, gold went up very sharply, and then from there gold has actually not delivered much return. So to be honest, trying to pinpoint what are the key areas in terms of what should we look at to go overweight gold or underweight gold. One is, of course, that if equity markets have done well, very well in the past, and your allocation to gold by virtue of that has come down, and you feel that there are probably some elements of overvaluation around equity, it may be a good idea to move towards gold. If you feel that the world is going towards high inflation, then gold becomes a good choice to invest. At the same time, deflationary environment means interest rates cuts can happen. That time, probably your fixed income can do reasonably well, but it all depends on what has been the recent past performance of gold relative to fixed income. If gold has done pretty badly, then gold can actually outperform debt even in an deflationary time. So starting point comparison as to what has done well, say last 2-3 years returns in equities have been very good and gold has not been that great, then maybe today gold becomes a good choice. So one is past performance and second is essentially the amount of liquidity in the markets and interest rates. As I had shown you in the chart, the expectation is that Fed has basically seen a peak interest rate. We may remain higher for longer is the rhetoric. I'm not sure if the numbers keep coming weak. We've already seen last week the US housing sales numbers come much weaker than expected. I think negative 6.8% or 6.7% versus an expectation of negative 5.5 or 5.6%. So it's weaker than expected in terms of direction. The employment numbers in terms of the incremental employment generation in US, which came I think a week back, that was also much weaker. So if the US economy is weakening, which essentially means that Fed at some point of may need to start cutting rates, which in terms of probabilities, the market is building in 50% probability that in May 2024, Fed will start cutting rates. And as was seen in the chart, which I showed you earlier, when Fed starts cutting rates, it becomes good for gold. So today, equities have already done well. Incrementally, gold can do well if Fed cuts rates. So equities won't do well or will do well. That depends on many other factors. But gold has a trigger. So incrementally, why not invest in gold? Equities, if you have space to invest, continue to invest. But if you don't have gold allocation, invest in gold. I think fixed income is an asset class which is probably currently lost in translation. India has high yields, no doubt. So India is still okay. But I think the preference should be ideally gold, equities, followed by fixed income. It again depends on the risk reward. But currently, that's how a fund manager would think, right? That I have probably more upside in gold. Why not allocate towards gold? You go towards the defense of fixed income if markets become too expensive. So in June 2022, there was a time where markets became too expensive and or rather markets had in October 2021, markets had seen significant outperformance. We hit an all-time high at that time. That time, if you could have shifted to debt would have probably been better than being in equity. So I think the valuation interchange and interplay between debt, equity, and gold is something which the fund manager always keeps seeing. And that's how the fund manager would increase their exposure. REITs InvITs also, it all depends on what is the interest rates. If the interest rates in the system are 7% and the REITs InvITs is generating a 6% yield, then that 7% is good enough to tilt in favor of debt. But then in REITs InvITs, if there is an uptick which is possible, and REITs InvITs and debt are returning the same, or REITs InvITs is returning slightly higher, then maybe REITs InvITs makes more sense. So it's all an interchange with the fund manager does. It's not a simple, it's not as simple as probably explaining on a simple video. But yes, these are the factors which the fund managers keep in mind. For gold, it's macro factors. For equity, it's more fundamental factors at a stock level and in terms of earnings. And debt has obviously got to do with what is the expectation of interest rate moving up or down. So these three are what the fund managers look at.
While we have created such a good base or good reasoning people to look forward to commodities as segment. Oh, just one question. While we all are from mutual fund industry, though we may be a little biased towards it, but being open, should we be going for commodities as a standalone investment option, or should we be buying mutual fund, or are you using the mutual fund platform to buy commodities? And if I may add one more line to it, whether it should be standalone commodities funds, which is possible or not, or a mix of equity, debt, and commodities combined. These two parts, please.
So today, in terms of, I think investors would want a simple allocation in a single fund rather than having to divide it between 2-3 funds. If someone is clear that I want allocation to silver because I have really positive view on silver, they can go for the silver ETF and silver fund of fund that's available in the markets. If someone is really bullish on gold, there are various avenues like sovereign gold bonds are there, gold ETFs are there, gold fund of funds are there. And then, of course, as part of the overall fund, there is gold a little. But if you're very clear, you want to allocate to a commodity, no harm in going and allocating to a commodity. But if as part of your overall allocation, you want certain commodity equities to be the core and debt and REITs InvITs, then I would think that through the mutual fund route where you get exposure to all of these in a single fund like the multi-asset fund, it makes more sense. If you are very clear you want directed exposure to commodities because you understand that commodity well, why not? Someone may say today that crude has fallen sharply from $100, $110 in fact to maybe $70, $75. And maximum downside that anyone would want to see, or you would feel that it is a 60, 65, if you feel that, and you say, okay, risk reward is in my favor, I want to go for crude, fine. So you can do it through crude exploration companies, or you can do it to crude as well. So I think individual commodities to trade, it's a very difficult art or a difficult science, if I can say so. So investors can do it, but it's difficult. I would suggest that instead of trying to master everything, if you get it and are allowing a professional fund management team to do it, right? So even like, for example, in our case, the multi-asset fund would have an equity fund manager, would have a debt fund manager, or a couple of debt fund managers. Someone will be doing covered calls, so dedicated covered call fund manager. Then you'll have REITs InvITs being handled by someone from the debt team. And then, of course, the commodity is also a specialized fund manager. So it's not one mind which basically takes all the decisions, even in a multi-asset fund, which is a professional fund, and that mind is a thorough professional having many years of experience. It's a team effort of 5-6 people to manage a multi-asset fund. So you as an individual, if you think that you can do it, you probably will need a lot of energy and experience and understanding and a lot of reading, which is very difficult in general. So I'd say leave it to the professionals. If you are sure about one particular commodity because you are a trader in that, or you know that commodity well, family business maybe in the commodity, you can go for that. But otherwise, leave it to the experts. The multi-asset fund through the mutual fund route is a good way to go by it. So in India today, there are 3 types of taxation. Earlier, there were 2 types of taxation. Now there are 3 types of taxation which are there in the mutual fund space. The first being pure or equity taxation, where you have long-term and short-term. Long-term capital gains beyond 12 months, if you keep, you get 10% plus some cess or surcharge. And then if you keep less than 12 months, you have 15%. That is known as the equity taxation. Now, equity taxation is provided to those funds which have more than 65% exposure to domestic Indian equities, right? So that's one set of investors or investor category with taxation. The second taxation is now, which was introduced, I'd say, in the post the budget, was essentially the indexation part. So indexation earlier was also available, but it was available to everyone other than equity taxation. So there were only 2 taxation. One was equity, which I spoke earlier, and the second one was debt taxation or other than equity. Now, for debt taxation, or you need indexation, much like how you sell a property and you get indexation based on the number of years you hold, and there is a cost inflation index, and you basically calculate the taxability. Similarly, in mutual funds, you will have now any mutual fund which has more than 35% in equity and less than 65, because above 65 you have equity taxation. So 35 or more and less than 65, you have something called as a debt taxation, wherein you get the benefit of indexation. So if you hold any fund which has more than 35% equity, less than 65% equity, you will get a benefit that after 3 years of holding it, you will get indexation benefit, much like how when you sell a real estate asset, you get that indexation benefit. And the third, which includes all your other assets, so your commodity funds like gold, silver, ETF, your international funds, your pure debt funds, or those funds which have less than 35% equity, they will be charged at marginal tax rate. So from an investor standpoint, these are the 3 taxations which are there. The multi-asset fund for various mutual funds can have differential taxation. At ICICI Prudential Mutual Fund, we've been having a multi-asset fund for a long period of time. We have stuck to the equity taxation part of it. So our multi-asset fund, which gives you exposure to equity, debt, REITs, in which commodities, is essentially a equity taxation product, where if you hold for more than 12 months, you get the benefit of 10% post-tax. So if you're investing, let's say in a multi-asset fund, it has 10 or 11% exposure to gold. By default, the upside in gold also, you're basically getting taxed at the taxation, equity taxation. So that's essentially the benefit that you get when you invest in a multi-asset fund, which has equity taxation. Each multi-asset fund of each fund house can have a different taxation. That's how the law is, rule is, based on how they run their multi-asset. But we pretty much run a multi-asset fund in a way that investors will enjoy the equity taxation in the ICICI Prudential multi-asset fund investment. I think we've lost the line of Anjanya. Yeah, Anjanya, please go ahead.
Connectivity issue here, seems.
No problem. We can hear you now.
Yeah. Okay. Great. Thanks. Like you mentioned about your own multi-asset fund. I believe it has completed 2 decades or even more, right? With such a track.
Yeah, so multi-asset as a category was launched somewhere in mid-2018 as a separate category by the regulator when the scheme categorization had happened. But the fund which we have basically converted to multi-asset fund was the dynamic fund, which erstwhile was the dynamic fund long-standing. It had some name change. So it's completed 2 decades. The multi-asset fund in its current form of having commodities also, which is 5 years or 5.5 years or 5 years old. But yes, the track record for the equity component of the multi-asset fund is almost 2 decades old because it is a 2-decade-old fund.
And what would be the size and a little more about the current constituents of the overall portfolio side of it?
So, Anjana, we are basically always believers of hybrids. I think we as an asset management company have always been pushing hybrids in a very big way. Balance Advantage Fund is always known to everyone, and we pioneered it many years ago. Multi-asset also is an extension to that because Balance Advantage Fund does not invest in commodities. So multi-asset fund has equity, debt, and commodities. And if you look at equity, debt, and commodities, it becomes a good choice to invest. In its category, multi-asset fund of ICICI Prudential is its largest in terms of size. In terms of performance, if we look at it, while past performance may or may not repeat, because of the process, the outcome has been something where we are satisfied in terms of the outcome. And what is the process? Let's look at the process. The process is, as far as the multiple asset classes are concerned, be in the right asset in the right quantum. Just to highlight, there was a time when equity assets were cheap in 2020. We had a good 77-78% exposure because let's remember, in terms of the fund construct, multi-asset funds need to have minimum 10% across 3 different categories or asset classes. So you'll have equity, debt, and commodity. So in debt and commodity, if 10% go, your maximum equity level, which is possible, is 80%. And we were almost near the maximum equity level in 2020 March when the markets fell. From there, we allowed the fund to grow in terms of its equity participation in the markets. And I think till about 2022, the fund remained in the high 70s of investment, which we brought it down to 70. And now today that number has come down to 55. So the first highlight of the fund is that there is no formula for increasing or decreasing the equity exposure, but based on our market view that, okay, markets have become slightly more elevated, we will probably have a step down approach in terms of reducing or increasing our equity level. So currently it's about 55-56% equity, 10% balance, which we require from a taxation perspective for equity will be in the form of arbitrage, and the rest is REITs, InvITs, and gold. So if we look at the current exposure, as I had shown, there is gold exposure, there would be some silver exposure. gold being 11% can show that I had shown the chart where we were 6% in gold some months back, we did 11. So there is very active involvement of the fund management team in increasing or decreasing the allocation. And why today higher gold makes more sense is because equities anyways are not very attractive relative to gold and relative to what the market has delivered. We all know that in 5 years time equities will deliver good returns, but then the job of a multi-asset fund is something which is to reduce risk and try and increase returns. And so with that in mind, the equity exposures have been reduced in multi-asset fund at ICICI, and we've increased the gold component. The debt component is pretty much steady state. In terms of duration, in terms of quality of paper, the fund managers will see to it that the right duration, the right quality of paper is taken so that you generate that extra yield. But in India, currently the yield curve is such that practically almost all reasonable quality papers are trading at a similar band for the next few years. So the government GSEC, of course, in terms of 1 to 10 year is almost a flat line. And even corporate debt is not differentiately priced. There's not too much differentiating the good quality papers. So it is a good mix on the debt side as well. In terms of the equity, how the equity is managed, because let's remember in the multi-asset fund, the key returns will come from what you do with the equity, which sectors you allocate to, where do you see in terms of the stocks selection. So if you go back 3 years, we were heavily invested in PSUs, we were heavily invested in value-oriented stocks, and we were away from sectors which were expensive. And if you go back 3 years and see, when you are away from expensive stocks and towards value, clearly you would be underperforming. So the underperformance was based on a process that what has not worked, what is cheap is there in the portfolio, and what is expensive, you avoided it. And just by market realizing that, okay, mean reversion has to happen, the expensive names for 3 years haven't given return, while value category has done well. You have a situation wherein the underlying constituents of multi-asset fund, which were tilting towards reasonably priced shares in the sectors which hadn't performed, you have a big return potential which has come in and which has basically fructified. So the important aspect is multi-asset fund in terms of its equity allocation is not trying to mirror the large cap benchmarks, is not trying to mirror the sectors or the stocks, but is taking a call on which basically sector or stock would do well. So there's what is called as a high active share. So you have a high active share. Active share means how much are you different from the underlying index. And in the multi-asset fund, you will find very high active shares at all points of time to generate that significantly higher return, which is possible. So you'll have intermittent times where market becomes irrational in certain securities and you go through that underperformance. But if you keep it for the long run, that will get nullified. So that's one of the major aspects of multi-asset fund and the way we manage it. We do a lot of covered calls as well, while I don't want to complicate because many people may or may not understand options. Essentially, we have existing shares, and on that existing shares, if we are able to earn some yield by selling call options, why not? And that's what we've been doing for a select limited portion of the portfolio. Gold, I've already spoken of, REITs in which I've already spoken of. We are basically always assessing that where is the mispricing and how we can participate in the various commodity markets as well as REITs investments. This is in a nutshell how the fund is managed. I think it's more than 24,000 crores in assets as we speak. And many people have again this thought that a large fund cannot do well. I think that this fund, and much like many of our other funds like Blue Chip, Value Discovery, has been able to dispel the truth. It's the processes which matter. And in that part of process, if you stick to it, sometimes there may be underperformance. Eventually, in the long run, with taking lesser risk, you're probably able to justify and generate wealth for the investors.
Perfect. So if I look at, while you were speaking, I was just referring to the performance over the period. So I think almost you are going to cross 25,000 crores very soon, and we wish you luck for that. Friends, I can just tell you this fund over a period of more than 21 years has given a CAGR of close to 21% plus. Even 10 years period return is close to 16% compounded, while the category average is close to 12.1%. 5-year CAGR is also 18.6%, while the category average is just ahead of 15% and so. So the category in itself is very important. We heard Chintan speaking about various components. Yeah, so the numbers are here. Yes, I was right, almost. Yeah, so there is throughout the period, there is an outperformance which we all can witness. We can see it here. And anything which is beyond 12% plus is in a way beating the equity returns. Where we all know equity markets, if they are giving 12% plus kind of returns, we should be happy about it. And here we have a portfolio which is mix of three asset classes, broad asset classes. And last 5 years, 7 year, 10 years return is in excess of 15% plus. So very healthy track that we have, and we are hopeful that the combination will definitely serve us on the return side. Plus, all of you partners who are there on call, a few insights, a few interesting points that we can look at are this product really becomes one of the similar product offering. If you recollect, there was one ad from a bike manufacturer way back in 90s. The tagline of that ad was "Fill it, shut it, forget it." So it's quite similar. You invest once and then reap the benefit for a longer period because you are actually taking exposure in all possible investment options which are there in market. So this is a long-term client retention strategy. If your clients don't have exposure to this one, then it becomes your upsell or cross-sell opportunity where you can bring in clients to multi-asset products like I approve multi-asset, which is very well positioned with good track record. That brings in confidence on the upsell side of it. Even SIP for that matter, we have seen, I was just referring to SIP returns also. SIP returns are also in excess of 20% plus for 5 year, 3 year, 2 year and 1 year. Even 10 year plus SIP return is in excess of 16% plus. That's a very healthy track on all the periods. Friends, this is like a product that at least I'm going to buy immediately next for my personal part. It's not a recommendation, but yes, I'm actually excited why, and I'm also feeling that why I didn't look at multi-asset as a product opportunity, just going by other equity market returns and debt returns part of it. Yeah, let's build portfolio on this side. This will be great conviction. Many of our clients also want SWP, that the recurring income coming in from products which are not highly volatile. This is a combination of three which are correlated or against related, inversely related. So in that case, even we can build a portfolio of SWP in multi-asset product portfolio, where you can have different combinations. You may start after 1 year of investment, 6 months of investment. So there is enough of buffer to manage any variances in the market or on either side of it. So the combinations can be created on SIP, SWP, and plus, of course, cross-sell and upsell, which is always an open window for all of us. And let's build our own exposure into multi-asset from here onwards. There are a couple of reasons for it. Gold, Mr. Chintan Haria has given enough reasons that gold and other commodities, the way they are moving from personal consumption to industrial side of it as well. We should be looking at them as well. Interest rate is positioned very ideal, very suitable in a different way because we are at a slightly elevated rate part. Any rate weakening or softening from here can benefit that in case if there is any duration call. Equity, we all know the way it is progressing. Large caps have not seen the real juice of the market slightly on last 1 to 2 years period. Small cap and mid caps have been the darlings of everybody, whether it is investor or the expert side of it. Now, large cap kind of portfolio can be there. While we take decisions on different asset classes, different segments of the market, best suited thing for all of us can be a mix of all three, which is multi-asset. I urge all our partners, let's look at it. Let's bring multi-asset in every client portfolio, and we are going to work together on ground for multi-asset, and especially iPro multi-asset, which has a proven track record, which we can showcase to all our clients. So Chintan, before we conclude, I would like your some additional views that you would want to suggest on a multi-asset, and then we can conclude. Yeah.
So we all keep talking about the benefit of investing long term. I just wanted to share the journey of multi-asset over the long term. 10 lakh rupees invested in multi-asset has become 5.7 crore versus index of 2.8. Now, the point here being that it's not always that in this entire 20-year journey, multi-asset fund would have done very well, right? So it would have done well, then it would have been phases where it does underperform the market, then again it does well. So if you look at the picture after 10 years, 15 years, 20 years, the true power of a multi-asset fund gets showcased. Great fund for SIP, like you mentioned, great fund for SWP, and currently our most recommended fund, even from a lump sum investment, given where the markets are poised right now, and the fund in terms of its capabilities has the ability to move towards large cap completely, can move towards large, mid, small, increase mid and small as and when the opportunity does arise, and the rest in terms of commodities, covered call options, REITs and WITs, debt adds to the overall yield. The key over here would be how efficiently the fund manager manages the equity portion in terms of the exposures, in terms of the sector allocation, in terms of the stock allocation. I think in the last 5 years, we've demonstrated our ability to do a reasonably good job from a risk and reward perspective. We are never only looking at trying to generate returns. We are always trying to manage risk. And as part of managing risk, the movements of sectors, stocks, segments within equity and debt and within commodities keeps happening all the time. It is a cumulative effort of the 4-5 fund managers who are connected with the fund directly and the investment team, which has 30 analysts plus the trading team. So it's a journey which happens because of the effort of many individuals. You all make it, of course, worthy of it by getting your investors invested in it. Thank you for partnering with us. And with that, I probably allow and hand it over to you, Anjali, sir. Thank you.
Thank you, Chintan. So nice of you for sparing time, and all the partners who came on Monday evening. Once again, thank you all. I'm sure these last almost 54, 55 minutes that we spent together are definitely going to add some pointers to your discussion with your clients, which ultimately will result in business and asset growth for all of you. We look forward to connecting with all of you on ground. Our team is there. iPro Multi-Asset Fund is one which we are adding to our kitty of selected schemes, which should be looked at. Wishing you all the very best, partners. And thank you, Chintan, once again. Thanks, Karan. Thanks, Bhavesh, for joining in and arranging it. We appreciate your time once again, please.
Yeah. Thank you so much. Thank you.
Thank you. And we'll conclude our discussion. Thank you. We appreciate your